Welcome to the webinar. My name is Marty Shenkman. I'm joined by I'm going to call him a friend and colleague, Winton Smith. We actually met not so long ago in Memphis, Tennessee. I always try to bring new colleagues, new topics, different topics, because I think our profession, our specialty of estate planning, to me, what is so fascinating about it is I don't think there's very many professions where you can help so many people. That's what we do is really help people. Intellectually, there's very few disciplines as challenging and fascinating. And the breadth of our profession is just incredible. I mean, we're going to talk about CRUTs today, but, we've done programs on beneficiaries with addiction issues, on a whole wide range of religious issues, cultural issues. We did a program a few months back on Hispanic estate planning. To me, there's very few disciplines in the world that demand so much of their practitioners as estate planning in whatever field you're in. So to continue that and to bring a new handsome face, make up for my less than handsome face, Winton Smith, who practices in Memphis. Winton, if you want to say anything by way of introduction, that's fine, and then we'll jump in.
Well, thank you, Marty. It's just a real pleasure to be here with you. And I've spent pretty much my entire career working in the area of planned charitable giving, and so the presentation today may take a bit of a sort of a development-oriented point of view because it's what I've done my entire career. But I couldn't be happier to have a chance to visit with you and the listeners about this, and it's just a real high point of my career. I appreciate you including me.
Our pleasure. So we don't have a disclaimer slide. Winton didn't put in a disclaimer slide, so we're disclaiming any responsibility for anything. So now you know we're real lawyers. Take it away, and I'll just interrupt you and comment to hopefully keep it lively, and maybe a few of my comments will sound intelligent.
Okay, Marty, let's go over to slide 2, please. Now, as Marty, as you, and please correct anything you see that you want to, Marty. Um, what we have here, of course, is the basic tax rates that are applicable in 2026. The income tax rate, the capital gains rate, the estate tax rate, and the huge exemption. And let's go, Marty, to slide 4. And let's begin with a simple cash gift. We're going to get to Unitrust shortly, but I would like to start by emphasizing how much you can do for your clients with an extremely simple idea that will then carry over into the area of Unitrust. Here we've got a donor who makes a $100,000 cash gift. And when he or she makes that $100,000 cash gift, they save $43,400 of federal income tax. Therefore, the net cost of that gift is $56,600. The next slide, Marty, shows the same gift, but it's now a $1 million gift. And that $1 million gift saves $434,000 of regular income tax and has a net cost of gift of $566,000. So, as everyone on the webinar knows, a cash gift, if made during one's lifetime, saves income taxes once. It saves ordinary income tax at the ordinary income tax rate. Now, let's quickly look at how someone can make the same gift and save income taxes not once, but save income taxes twice. Because if one can make the same gift and save income taxes twice, that's going to lower the net cost of that gift. And I think, as most everyone on the webinar knows, the way that is done is by the client giving some type of long-term appreciated property. It's either long-term appreciated stock that one has owned for over a year, or long-term real estate that's an investment asset, in the current environment, it's many times the really huge gifts now are gifts of family business interest. So let's go to the next slide, Marty, and we'll look at the difference in the cost of the gift. Here is,
Let me
yeah,
just interject.
sure.
We're not getting into some of the various issues with standard deduction and itemized deductions and the 237th haircut. We're focusing on the big picture first. So those things
That,
are out there, but Winton's trying to um, um, explain the concepts which are most important. So we recognize there's some nuances and refinements to this, but that's not the big picture.
oh, thank you, thank you. So here's the same $100,000 gift, except now the lawyer has cared enough about the client and listened enough to the client and actually done a careful review of the client's assets. So the lawyer is able to now come back and say, instead of making a $100,000 cash gift, why don't you consider giving $100,000 of appreciated stock? Because if you give that $100,000 of appreciated stock, you're going to get the same $100,000 deduction for the fair market value of that stock that you would get for the cash gift. So by giving the long-term stock, you get the same $100,000 deduction. You save the same 43,400 of income tax. You just now also save the $23,800 of capital gains tax. And by totaling those tax savings, you've reduced the cost of that gift down to 32,800. So Marty, if we go to the next slide, there's the $1 million gift, but now saving taxes twice and reducing the cost of the gift. If we go to the next slide, there's a comparison of the cost of the gifts. Now, Marty, I suggest that certainly you and maybe many, many people on this webinar are thinking, you know, we knew that. I mean, that's simple. I remember once I was in New York talking to Sandy Milbank, and Sandy said to me, Winton, if you don't have more to offer than that, this guy was in investments. He said, I'm not sure you've got much to offer. And I said, Sandy, this is a dog that'll hunt all day and night. And let me just give you a couple of um, examples of this. Just to, I hope this is okay to talk a little about just, you
I
know,
think I think everybody in New York City, Chicago, and LA wants to hear about a dog that hunts all night because we all need that.
well, I can recall uh, a guy named, I'm just going to give you their first names, Jim and Larry. I gave a little talk to their board at the university board for about 15 minutes. They were going into a capital campaign. Jim comes up to me, and he's actually the chair of their board and the chair of their campaign. And Marty, he said, I want to make $100,000 gift. And of course, I'm thinking, good land, this university is going into a multi-million-dollar campaign. And here's the guy who's the chair of the campaign, and he's thinking about $100,000 gift. That's not exactly going to set the pace that's going to ensure the success of the campaign. But, we were in a hotel and where I often am doing the kind of work I do. And I said, Jim, let's go into one of these rooms here where the doors open. Let's go down to the head of the room and sit across from each other on one of these little tables that's set up for maybe a seminar this afternoon, and let's visit. And we went down there, and I listened to Jim and Marty. To make a long story short, here's a guy who had a gift for selling. He was a heck of a salesman. He was a pharmaceutical salesman. And this guy was working for a major pharmaceutical company. And what would happen to him is he'd start to make so much money, they'd call him up to New Jersey. They'd take him into a room with a group of suits, and those suits would either cut his commission or cut his territory. And that happened to him about 3 times. And then he said, you know, he calls up his brother, who's a football coach. And, he says, Larry, we ought to just start a company and sell these pharmaceuticals ourselves in our company. And that's what they did. And I'm sitting down at the front of this seminar room talking to Larry, and he said, to Jim, and he said, we've been offered $30 million for this company. And he was in a real ethical bind because he knew if he sold that company, the first thing they'd do is cut his employees. And he said, Winton, the reason I'm worth $30 million is I hired good employees and I never cut their territory. I never cut their commission. They've made us rich. But what he, of course, also told me, Marty, was that when we looked at his assets, here was at least $15 million with almost no basis. So that $100,000 gift became a $3 million gift. When he could see that he could give that highly appreciated stock and get a $3 million deduction, and he would certainly need it when he sold that company to offset that huge gain. And then his brother Larry was going to give $100,000, but he wasn't going to be outdone, so he gave another $3 million. So what was a $200,000 gift became a $3 million gift. And, as a lawyer, I felt good because that's what those guys wanted to do. That's what they wanted to do. They went to the University of Southern Mississippi. They lived in Jackson, and all they ever heard about was Ole Miss. And they thought it was time to, make a move for the home team. So they gave $6 million. And I've just seen that over and over and over again, where if the lawyer or the accountant or the insurance advisor, professional advisor will take the time to really listen to somebody and then do the same kind of estate analysis of assets that we do in estate planning, you may all of a sudden figure out or find out that there's something that's a much better asset for them to give, like highly appreciated property. And I've just seen it over and over again. I've seen $100,000 gifts become $7 million gifts in about 6 months. And now, admitted, it's with somebody who he and his wife, they wanted to make a gift. They cared about this organization they wanted to benefit. And, but when they all of a sudden saw what they could do, it gave them a great deal of joy to knock that ball way out of the park. In my view, that's a very valuable service for the lawyer, the accountant, the insurance professional, the financial planner. I'll just say one more thing and then we'll move on. And I hesitate because we don't believe in bragging where I come from, but I've talked with some people who, they owned investment firms. Some of you probably know the name of Peter Lynch up in Boston. The boy made some money, but, after having a chance to get acquainted, maybe do a seminar up there, it was then that he started giving appreciated stock. And of course, he did a unitrust. He did most every gift that we have in our gift opportunities. Now, when it comes to the charitable deduction, as Marty was saying, there have been changes, of course, regrettable changes. But it's still true that if one gives cash, you can deduct, if you itemize, up to 60% of that donor's adjusted gross income. It's actually their contribution base. If they give long-term appreciated property, you can deduct up to 30% of their adjusted gross income or their contribution base. And happily, we've got a 5-year carry forward. So if somebody makes a $10 million gift this year, but they can't fully use that $10 million deduction, they've got a total of 6 years to use that deduction, the year of the gift plus 5 additional years. Now, the One Big Beautiful Bill, as Marty pointed out, has introduced a provision that now reduces an itemized donors, charitable contributions by the amount of 0.5% of their AGI. So if we go to the next slide, Marty,
Hey,
we look
when
there.
do you have any idea why they did some of this and the 2/37 reduction on charity?
You
I
know,
mean, the government, I would think, would want to encourage charity.
well, one would hope so. I don't know, Marty. I guess they were just looking for ways to try to have some sort of uh, reduction in income to offset some of the tax breaks that were
Yeah,
included in the One Big Beautiful Bill. And I suppose that maybe someone thought this would be one that maybe wouldn't get that much attention, and therefore they went down this avenue. But that I'm surmising that, Marty.
yeah,
I don't really know. Uh, but if we take an example of the application of that 0.5% deduction, if somebody's got $1 million of AGI and you do the arithmetic times the 0.5%, that means that the first 5,000 of their charitable contributions are now non-deductible. So if their first $10,000 gift is made, their deduction for that $10,000 gift, which used to be 10,000, is now only 5,000. They also capped the tax rate for philanthropists, donors, clients who are in the top tax bracket. And so if someone in the top tax bracket makes a charitable contribution, their tax bracket there is capped at 35% for those tax savings. And so that, of course, limits the value of the charitable deduction for those in the top tax brackets, who, of course, are most of the people or many of the people who make the much larger gifts. So the One Big Beautiful Bill, in this respect, was not favorable to charitable giving. Now, if we look at the next slide, there is a positive impact of the One Big Beautiful Bill in that there is a new above the line charitable deduction for non itemizers. If they make gifts, cash gifts to public charities, then a client can make $1,000 cash gift to public charities and get above the line deduction for that. A married couple could, if they each give 1,000, they now have a $2,000 opportunity to make a charitable gift that's deductible above the line. And Marty, as you know, most taxpayers do not itemize. So, in terms of the entire populace, that's a positive development. And we're glad to see that. Uh, Marty, let's go from this slide over to slide 20. We'll come back to gifts of family business interests, but because I really, really do want to talk about that before we conclude. As I said, it's with gifts of family business interests where we're now seeing just gargantuan gifts. And, boy, if there are ever people who need help from the people on this webinar, Marty, it's people who own family businesses, as you know. But since we're talking today about Unitrust, let's go next to gifts that provide a life income and look at how those gifts work. There are a number of different types of gifts that provide a life income. Those gifts are on the screen. Charitable Remainder Unitrust, which is my favorite, Charitable Remainder Annuity Trust, Charitable Gift Annuities, Deferred Payment Gift Annuities, Pooled Income Funds. Today, we're going to focus on the CRUT, Charitable Remainder Unitrust. The CRUT, what a inviting term. Let's go to the next page, right, Marty. Now, here's what happens when your client makes a gift to a charitable remainder unit trust. And it almost always happens. And there's no magic here whatsoever, as you'll see. But typically, when the right client sets up a charitable remainder unit trust, I'm going to go ahead and cut to the close. It's probably going to quadruple their income. It's going to quadruple their spendable income, and maybe more than that. Then, as they make this gift that quadruples their income, they're going to get an income tax charitable deduction that's going to save them a lot of income tax. And then they're going to bypass a penalty confiscatory capital gains tax. And if their estate is large enough, they're going to bypass estate tax and have the joy of making a gift. So let's look at an example of this. I often hesitate to go over those results because someone may think, this guy's selling snake oil. I'm not selling snake oil at all. And let's just look at how it works. There's no magic to it. Let's go to the next slide, Marty. Here's an example, and I've assumed almost no basis in these assets because I see that frequently, but I've also done that to try to keep the arithmetic simple, Marty. Here we've got $1 million stock, and it's got almost no basis, so we've got a $238,000 capital gain. Now, as everybody on the call knows or on the webinar, if somebody sells that stock, they're not going to have $1 million to invest. They're going to have $1 million less 238,000. But if they take that $1 million stock and go to the next slide, and they put that $1 million stock over into a charitable remainder unit trust, and they set up that unit trust to make an income payment to themselves for life, and then eventually to their charitable interest, there are a number of things that are going to happen here. When they put that $1 million of stock in that CRUT, if we go to the next slide, Marty, I was assuming that this was a typical growth stock. Many typical growth stocks may pay a 2% income. If this growth stock paid a 2% income, they put it in a unit trust paying an 8% income, their income goes from $20,000 to $80,000 a year. And that $80,000 income payment is not subject to the Medicare tax either, the 3.8%. So that gift to that unit trust has quadrupled their income. And of course, there's no magic at all. And then I've assumed here they get a partial income tax charitable deduction of $500,000. If they get a partial charitable deduction of $500,000 times 40%, that's going to save them $200,000 of federal income tax. And then they next save $238,000 of capital gains tax. If the estate is large enough, they save $400,000 of estate tax. So you've helped a client who has a charitable interest, who may have a growth stock that they're ready to diversify or they're ready to sell. They maybe would like a little more income, spendable income, not capital gain. And all of a sudden, you've shown them a way to do that that's absolutely solid legally, that's going to quadruple their income, save them a lot of income tax, eliminate a tax on the sale of that asset, and save estate tax, which is not a bad result. Now, let's go to the next slide, please, Marty. That income that comes out of that unit trust, that's going to be taxed according to a 4-tier system. And the 4-tier system is ordinary income comes out first, capital gains income comes out second, tax-free income comes out third, and then tax-free return of principal. Some years ago, if we go back to the prior slide, Marty, if we go back to the prior slide, some years ago, people were trying to say, you know what? You can put in a million of that growth stock. Let's say it's got a $200,000 basis or whatever the basis is. And then once it goes into that unitrust, the trustee can immediately buy tax-free bonds, and that'll pay out 80,000 of tax-free income. And Marty, that was incorrect, because when the $1 million of appreciated stock goes in that unitrust, it's a lifetime gift into the unitrust. So the basis carries over into the unitrust. There's $1 million of appreciated stock in that unitrust. And when that stock is sold, you've got $1 million of capital gain in that unitrust. So if we go to the next slide that shows the taxation of income, and we start down through our list.
I'm not sure which slide you meant. I'm sorry.
The next one. Go ahead. This one right here. This
Okay.
one right here. You got $1 million of appreciated stock has been sold in the trust. So even if you buy tax-free bonds and that's all that it pays out, you don't get immediately tax-free income because we have to go through the tier system. Does it have any ordinary income? Maybe not. But has that trust ever incurred a capital gain? Absolutely. Didn't pay any tax on it, but has incurred a capital gain. So that income out of that unitrust is going to be capital gains income for the first several years. So the idea of getting an immediate amount of tax-free income out of that trust, that's just not how it works. Am I clear on that, Marty?
Yeah, I was just going to say that I find clients are often surprised by this. They've heard somewhere, and I'm not sure where, everything coming out is tax free. No,
Yeah,
it's
no, that's
not.
right. Now, a lot of times people would say, I mean, to me, it is an enormous benefit that whether you have $1 million of appreciated stock or $100 million business, you've got a basic choice. Do you want to sell that stock and that business and pay tax? Or would you prefer to sell that stock and that business and not pay tax? And if the idea is they'd like to sell either of those assets and not pay tax, then a charitable remainder unit trust provides that option. And, the fact that it's then paying out capital gains income, that's not the worst thing in the world. Capital gains income is taxed at a lower rate than ordinary income. And moreover, the charitable deduction you get on the front end, you may be able to take that deduction and spread it over 4 or 5 years and offset that capital gains income. So, when we talk about the capital gains savings from a unit trust, I've always said you get a tax-free sale. You bypass that penalty confiscatory capital gains tax. Now, a lot of lawyers prefer to say, accountants prefer to say, no, you don't bypass that tax, you just defer it because you get to defer that capital gains income over your life expectancy. And that's true. But on the other hand, if you had a choice between ordinary income and capital gains, that's not all bad to get the capital gains income. And so, that's the way I've tended to talk about these things with people once I decide they have charitable intent. If they don't have charitable intent and they come to me and, somebody sold them on the idea that this is a way for them to make money, I usually don't, I don't want those clients, Marty, because I don't think that's true. Although we'll look at some examples here today where it gets awfully close to being a zero cost gift, but you need clients who have at least a modicum of charitable intent. Now, sometimes when they see these results, Marty,
It
you can
motivates them to
see,
have charitable intent.
you can see that charitable intent grow right before your eyes.
Yeah.
It's amazing. They have an epiphany. I mean, geez, let's go to the next slide. Now, of course, many times, and I've had this situation, you're talking to mom and dad, and maybe you've met with mom and dad, and they're really ready to do this. And then all of a sudden at the last meeting, you go, maybe even at my suggestion, and I meet with mom and dad, and they bring in Muffy. They bring in their son Muffy. And Muffy, he's about, I don't know, 25. He went to the best schools. They registered him in the best schools before he was even born. He's been to the best colleges. He's probably got a business degree. And they bring Muffy into the meeting, Marty. And I explain this unitrust to mom and dad again.
What
They're
am I
excited.
getting? He asks.
And then Muffy says, what? Exactly. What about me? And the proper answer to that is for mom and dad to say to Muffy, son, get a job. You're 28 years old. You never worked a day in your life. Get a job. But they probably don't want to do that. So we need to come up with a plan that provides for Muffy, that we ensure that this poor kid never works a day in his life. And you can do that, of course, by adding an irrevocable life insurance trust that's come to be called the Wealth Replacement Trust. And so if we go to the next slide, Marty, you set up an ILET, you let the trustee buy $1 million of life insurance, and the trustee own the insurance, and you let the income tax savings that you got from the unitrust, you let the government pay the premium to replace the gift for the children. And then that insurance trust, as we know, goes tax-free and then goes estate tax-free to Muffy. And, it's a good plan. There's nothing wrong with it. Um, you know, if one is in the insurance business, that's another dog that'll hunt all day and night. Now, in my experience, and, I'm just going to be candid, in my experience, that's been a very helpful idea to show the clients. But not every client's going to want to do that. There are parents who are going to say, we sent Muffy to, the collegiate school here in New York. We sent him up to Groton. We sent him over to Harvard. We sent him maybe down to the Wharton School for Business. And, we're going to be doing quite a bit for Muffy through the estate. We don't necessarily need to do this. So I found the ideas useful, and sometimes they do it. And they're huge insurance policies, but they don't do it every time, Marty.
Let
Let's
me
go
let
to,
me let
yeah,
me
go
give you a
ahead.
little spin on that.
Yeah,
With sort of the more popular use of spousal lifetime access trusts,
yeah,
instead of creating a simpler life insurance trust that you're making annual gifts to pay the premiums for part of the wealth replacement plan, sometimes we'll create a more robust slat and make a large gift of a slice of the business into the slat. So the future appreciation is out of the estate. The gain is there. You still have the grantor trust burn. And we build in insurance provisions into the slat so that instead of having a simpler islet you're funding with cash, a slice of the business is there. And in effect, when the business is sold, it pays those insurance premiums in perpetuity from the gain that's inside the slat. Because the slat is really not much different than an islet if you add the insurance provisions. It's the same concept.
I have created slats uh, for clients, and they have been very pleased with that. Marty, that's a great idea.
And you
That's a
don't
great
have to
idea.
make the decision when you first do it. You just build in the insurance provision. So if they want to get a slice of the business out of their estate, you can always add the insurance later. Just build it in. And one of the things I find you need to build in is naming a separate, if it's a directed trust, which most of the ones we see are, a separate trustee or advisor for insurance, because you don't want the client, who will probably remain like an investment advisor or trustee for the business, but you don't want them having any 2042 issues having control over the insurance. So you build in an insurance plan. It's harder to graft this onto an existing trust after the fact, because the last time that we dealt with it, we were advised by Delaware counsel that we couldn't just have the trust protector bifurcate trustee duties. It had to be a decanting or a non-judicial modification to add it. So just throw it in, and now you have the flexibility.
Marty, this is why I'm so thrilled to be having contact with you. I did not know that, Marty. That is an improvement for me personally on that idea, and I thank you.
We'll have to come up with another name besides Wealth Replacement Trust to make it sound more exciting.
Well, and here's the same idea, of course, just putting the unit trust next to the Wealth Replacement Trust. But thank you, Marty.
And one last comment. We have not used an insurance trust, insurance plan in many of the CRUT type plans that we've done, or charitable bailouts of family businesses. I try to recommend it all the time, because then the client's making the decision not to use it. I don't want the kids to come back, or even the client, years later and say, hey, what about, I'll use Winton's example, what about me, Muffy? So recommend it. And sometimes they're not insurable. Sometimes the insurance is too costly. Sometimes they just don't care. But I think it's a helpful thought process to go through it. And another point, and I try very hard to always think defensively, because the estate planning profession has some of the most challenging malpractice claims. And don't think because you're an accountant or a wealth advisor or insurance consultant, you didn't get pulled in the soup. Everybody gets pulled in the soup. But if you have the client meet with the insurance consultant, and the insurance consultant does the projections and shows them what this wealth replacement concept, whether it's a SLAT, a simpler ILET, whatever it is, what it can do, and they reject it, you now have another advisor that's explained it. And every advisor in each profession always views things differently, explains things differently. That's why having Winton explain some of this, it's different than when I worked with an accountant on a charitable planning, a couple of charitable planning webinars, maybe last year or something. Everyone approaches it differently. And I think it's helpful, because the clients may understand the concept better when they hear it from two different people with different perspectives. But it also protects everyone else on the team, because now you had another person, the insurance consultant, who explained it to them and can say, hey, they knew what was happening. I explained it. Here are the projections we showed them.
Yeah. Temperamentally, Marty, I'm not inclined to want to do things by myself. I really value the being part of a team.
Well, yeah, I'm a zealous
Both
believer
because
in that.
I frankly need to learn more always, but also there is that practical aspect. There's more protection in that, in terms of your practice, that we all have to be concerned about. Let's go to the next slide. Now, Marty, I may ask you about this one before we get through this example. So get ready, okay?
Okay.
I may put you on the spot. Marty, let's say that a billionaire comes to you. And now I thought I had a good example here, but I know, Marty, you probably turned down more billionaires because they were trying to do something illegal than any lawyer in the world. But I'm going to continue with this example. This guy's a billionaire, all right? And he comes to you and he says, Marty,
I want to pay the wealth tax in California. I'm sorry, that just slipped out. Just slipped out.
Marty, I've got this parcel of real estate. Marty, would you believe it? This parcel of real estate is right next door to Mar-a-Lago. I mean, right next door. Okay? If you go to the next slide, Marty, this parcel of real estate is worth at a minimum $100 million. And I got it for practically nothing. I got it before anyone else moved into the neighborhood. This was years ago. And it's just raw land. It's not producing any income. And I'm thinking now with the political situation, all of the attention that's coming to our area because of the president's home here, it's time for me to sell this $100 million asset. So, Marty,
Am I going to flip thinking of the answer?
no. Oh, are you ever good? Oh, are you ever good? Just hold that. Oh, you're so good. Let's go to the next slide.
My tax sense of humor? Or
Oh, you've already got it. You've already got it. So, Marty, you say to this person, John, you and Mary, I know you're very devout. With that kind of money, they've got to be Episcopalians because that's what happens in the Protestant world. If you got a lot of money, you become an Episcopalian. You can put this $100 million into a charitable remainder unitrust with an 8% payout. And let's go to the next slide. John, Mary, if you put that $100 million parcel of real estate in a charitable remainder unitrust, your income will go from 0 to 8 million a year. You'll get a $500 million charitable deduction at a 40% rate will save you $220 million in income tax, save you $23,800,000 in capital gains tax, save you $40,000 in estate tax. And so it'll provide quite a result for you. So John and Mary, Marty, they start to get kind of excited about this. Let's go to the next slide. They say, let me see if I understand this. If I put this $100 million parcel of land next to Mar-a-Lago in this trust, I'm going to get an $8 million income. How soon can I get that income, Marty?
they want it immediately.
Yeah. Can I get it? Can I get it quarterly? Can I get it semi-annually?
Get whatever you want.
Can I get it annually?
Whatever you want. And especially at these amounts. A lot of times we see with smaller CRUTs, because they even make sense for clients that are nowhere near these phone book numbers and wealth. For a lot of clients, it's just a great technique, and we'll make an annual or quarterly payment because it's just not enough money for the administration of it.
Yeah. Well, looking at this result, Marty,
it's a good deal.
We're ready to go. We're feeling philanthropic. Oh,
yes, that's the word for it.
That's my heart. Let's go to the next one. Let me ask you a couple questions, Marty. Can I be the trustee?
I would never do that. I don't like to do that.
But can I legally be the trustee?
Probably.
Can John and Mary be the trustee?
Yeah.
The answer to that, Marty, is yes.
But I don't like to do that.
Really?
Yeah.
I can't imagine why. I worked with a physician in New York that was a world-class physician, and he set up a CRUT, and he wanted to be the trustee, and he became the trustee.
And I'm sure his medical knowledge gave him perfect background to do that job.
Marty, this guy didn't even file tax returns.
so why are you asking me why I don't like to do that? Now you just answered the question.
No, I don't either. I don't either. But you could be working with a doctor, perish the thought. You could be working with a lawyer.
Oh, even worse. I didn't say that.
Doesn't have enough presence to realize what he or she doesn't know. But can they be trustee? Yeah, they can.
Yes,
so
let's differentiate. Should they be?
They should not be. Probably not. Peak Trust Company, another good trust company. Um, Many times a university may be trustee. Is that a good idea? Maybe sometimes. Um, but
If
should
it
the
one of the
individual be trustee? Probably not. Yeah.
yeah,
Go
one of the
ahead.
things about naming the charity as a trustee, what if you want to change the ultimate beneficiary?
Well, it's interesting, Marty. I spent my entire life representing colleges, universities, seminaries, um, a lot of different types of charities, including, uh, the charitable community is really large, as you know. I had a chance to represent what's that group in New York, the Foreign Affairs Committee on Foreign Affairs up that all the Secretary of States are in. They're just a really broad group of charities, and my clients had always been a charity. But if the donor asked me, should I retain the right to change the charity, which you can do, as you know, Marty, you can do that. I'd probably tell them yes, because you just never know. And it's the job of these charities to be absolutely faithful to these donors and to give them a continuing reason to want to support them. So I guess even though my entire life has been representing charitable organizations, I'd probably retain that right and hope I never had to use it. Um, you know, as you know, that's very possible that you can put in that agreement that the donor can retain the right to change the charity, provided they change it to another qualified charitable
Right.
organization, and they can do that after the trust is created. Let's go to the next
Yeah,
slide.
that's an important piece of flexibility. And one of the reasons I think that's important to do is the world is changing at such a rapid pace. I mean, it's hard to imagine what the world will be in 10 years from now with what AI is doing to transform everything. And if you name a charity, what if that cause is just it's obviated? So having the right to change the charity is a good piece of flexibility.
Yeah. Now, what if the donor then says, "Oh, well, if I can be the trustee, Marty, because this unitrust is going to be revalued each year, that's one of the principal benefits of a unitrust. You've got a hedge against inflation.
Absolutely.
If I
That's
put,
really important. You should emphasize that because I don't know if we said that before.
I don't think
It,
I did. I don't
no,
think I did.
and the
Yeah,
inflation hedge is very important in the current environment, but it's also important in any environment if you have somebody that could live for decades to come.
yeah, yeah. It's most unitrusts that I've worked with. If somebody puts in 1 million, by the time that unitrust terminates, it's at least 2 million. Now, why is that true? What
Time
did
va
Ben? What did Ben?
compounding.
What did Ben Franklin say is the eighth wonder of the world?
I thought it was Einstein.
Was it
Compounding.
was it Einstein?
I think so.
Okay,
I may be wrong, but I think it was Einstein.
no, my apologies to Einstein. What did Einstein say is the eighth wonder of the world?
Compounding,
Compound interest.
right?
And although I admire Einstein immeasurably, that's wrong. The eighth wonder of the world, Marty, is tax-free compound interest,
Okay.
which is what you get in a unitrust. You do. I mean, once that unitrust is set up, that investment can be made and can grow. And every time they change investments, there's no capital gains tax. So that unitrust with a good investment advisor, that's the reason I like the unitrust rather than the annuity trust, which is a fixed payment based on the initial value. It can. So the guy asks you, can he be the one who does the annual appraisal? The answer to that is no. In the unitrust agreement, you've got to appoint an independent appraiser who will do that annual appraisal. And that is a requirement. What if he says, and I certainly got this question over my career, hey, if I'm giving $100 million to Cooper Union University, which is one of the absolute best universities in the world, can't they pay my legal fees, Marty? I mean, they
I
should
don't,
be able to pay my legal fees. Good
I
Lord,
don't,
I'm giving them $100 million.
if you're trying to help a charity, the client's trying to help a charity, they shouldn't be trying to pass off their expenses onto the charity.
Yeah, and I think
And if
also,
they're
I
worth
think,
$100 million, no disrespect to the client intended, let them pay the legal and accounting and other professional fees and appraisal fees.
I think they put themselves at risk too. You know, if the charity pays the legal fees, we've got the reporting requirements, and I think if the charity pays them the legal fees, that would be as something gifted back in exchange for the gift. So I think that's a terrible idea.
What about
Now,
the attorney receiving a fee from a charity as opposed to from their client? Who are they representing? I not a good thing for a lot of reasons.
well, it's not, but I have known very, very fine lawyers, very fine ethical lawyers who, in that situation, provided they are assured that this is what the client wants to do, Marty, will have the client sign a waiver acknowledging that the lawyer represents Cooper Union as well as them and requesting the lawyer in that waiver to serve as their personal attorney with full knowledge that they also represent Cooper Union, and the lawyer will draft the agreement. Do I think should be the standard practice? No. But personally, if that's a really good lawyer, somebody who practices like you do, Marty, and I'm not kidding, if it's somebody like that, I don't think I have a problem with that. Now, if
Well,
it's
you
somebody,
got to be careful with the waiver, but
yeah,
again, I just find the environment that we're working in over the decades has gotten more and more worrisome, nettlesome.
yeah,
So to me, it's just better not to.
I think it's better
And
not.
it's one thing about the waiver, but another thing about getting the fee paid.
Yeah. Well, I think it's preferable not to do either. Um, and I would only, be okay with it. Marty, I'm being very direct here. If you call me and had that case and said, Winton, this guy and lady, they're not going anywhere else. I can tell you, they're not. I've asked them to. I've given them four names. Um, they're not going anywhere else. And Marty, I would be okay with you doing that. But now I know we're talking about the exception here. There are a lot of lawyers I wouldn't be okay with it at all, or accountants,
I
but
think the message is just be careful. It's
yeah,
in my view, it's not worth the risk, not worth
yeah,
the potential
I, I
issues.
I agree with that on all three of these questions. Let's go to the next page, please. Okay. So John and Mary say to you, Marty, some charities are afraid of real estate. They just think it's a problem. Now, I can tell you that this is not a problem because number one, this is $100 million worth of real estate right next to Mar-a-Lago. And incidentally, Marty, I've got a buyer waiting in the wings. I mean, the buyer is ready to go. He's just
Well,
waiting for me to get this in the unit trust.
well,
Is that a problem?
there's a couple of questions. First of
Okay.
all, depending how close those wings are, you may have an assignment of income doctrine, and I don't know if you're going to cover that later, but you got to be very careful how far the client has gone to, there's a path. Here's nothing going on at all. I got a signed contract, the ink's still drying. The closer you are here, the better. The closer you are here, not so better. And at
Yeah.
some point, moving down that continuum, you reach a point somewhere on the continuum where the IRS is going to say, hey, you assigned the income from the sale because it was a done deal.
Yeah.
Um, and that's a real issue with lots of clients on all kinds of planning. We all see that all the time because clients are afraid to pull the trigger until they know they have the exit strategy. And if they don't get the exit, they don't want to pull the trigger. Well, but that they got to, you got to make a decision and you want to be closer to here than to here. The
Yeah.
other issue to me, if it's real estate, why not put it into a single member LLC? It's disregarded. and then the charity's protected. And a lot of charities, they'll do like environmental due diligence before they'll even accept the LLC.
which they need to do.
You don't want a problem.
Marty, let's go to slide 41.
Okay,
Just
just
jump
so you
ahead.
know, maybe in 10, 15 minutes, we should start to wrap up.
Okay. Okay. Um, so, Marty, they want to put this $100 million of real estate in a standard CRUT. Is that a good idea? Now,
Depending on their goals.
the guy's
The
assuring you
problem, the problem is how you're going to make a payment.
if you're
You
putting in
can't,
100 million of raw land.
yeah, you can't give a shovel full of dirt as your unitrust payment.
Okay. Okay. So it's
I've
best
never
not to.
seen anyone try that, but it'd be intriguing.
Well, it's a horrible idea, isn't it? Because even though the donor, as you say, is assuring you there's a buyer waiting in the wings, that buyer may disappear. And
They
all of a
have
sudden, Cooper Union's got to pay out $8 million, and there's nothing but raw land in the trust.
not good.
Not good.
And by
Not
the
even,
way,
yeah,
I'm sorry to interrupt. If you did a standard CRUT with raw land or any non-income, non-cash flow producing asset, and then it's sold very quickly, doesn't that kind of the fact that you structured it that way suggest that you knew it was a done deal? Because why else would you take that risk?
that's correct. That's correct. I'd wait at least a week.
Okay.
Now, you know the answer to this, Marty, because you gave a joke about it. There are four types of unitrust. There's the standard unitrust where you put in the 100 million, you got to make the 8% payout. Or the income payment could be expressed payout 8% or actual income earned, whichever is less. Or you could have it say pay 8% or actual income earned, whichever is less. But if you ever make a payment that's not 8% and you later earn over 8%, go back and make up the difference. And now we've got this wonderful option called a flip unitrust that was developed within the IRS by a wonderful lady by the name of Frances Schaefer, really smart lawyer. She came back and worked within the US IRS and said, why can't we let people set up a net income plus makeup unitrust, but put in the trust an event where if they want, it can flip over and become a standard unitrust. And so the answer here, as you knew, Marty, was put in the 100 million of real estate, let it be a net income plus makeup so you don't have to pay anything out until it's sold. Then make that next payment the first of the next calendar year where you can make up all those deficiencies. And then after that, you've got the standard 8% payout. Now, if we've got 15 minutes, Marty, let's go over to slide 67 if we can get over there. I'm sorry that
No
maybe.
worries.
Okay. Now, the Secure Act, as everyone on the slides and the webinar knows, if we go to the next page, the Secure Act changed the law in terms of the planning of IRA distributions. You used to be able to plan those distributions over the beneficiary's lifetime. The Secure Act comes along and says, nope, with the IRA, you can plan it over the surviving spouse's lifetime, but after that, no more than 10 years. That Secure Act change to limiting the payouts to the surviving spouse's life plus 10 years is a huge tax increase. And that has opened the door for a plan that I think can be extremely beneficial. let's go to slide 76, please. Now, the best charitable bequest, and I'm going to try to cover this quickly and then we'll go to the slide that's on the screen. The best charitable bequest is always a bequest of IRD assets, because IRD assets produce income tax in the estate. So even with the large estate tax exemption, if you bypass a 40% estate tax but run right into a 40% income tax with IRD assets, that's not good. So with the simple charitable bequest, and I probably should have put this in our outline, Marty, you want to have a paragraph in that will or revocable trust that says always pay the charitable bequest first from IRD assets. So you make it payable from IRD assets. As you know, Marty, IRA distributions are taxable, income taxable. And now that the Secure Act has said those income payments have got to come out over the spouse's lifetime and no more than 10 years, that's pouring a whole lot of taxable income over a short period of time into the beneficiary's income tax. And so, if it's a married couple, the ideal charitable bequest many times is primary beneficiary of the IRA spouse, contingent beneficiary, Cooper Union, NYU, Columbia, the Jewish Theological Seminary, whatever charitable organization the person prefers. If they're not willing to do that, then the IRA can be payable primary beneficiary into what I call a standby unitrust. The IRA goes into the unitrust income tax free. It's then paid out to the spouse over her lifetime. And then at her passing, it goes to their charitable interest. Now, you, of course, will want to compare that to a marital trust. But let's suppose that, this is Bill Clinton setting this up. And Bill definitely wants his IRA to go into a standby CRUT for Hillary. But Bill wants that standby CRUT that provides for Hillary to then go to Georgetown. Well, if he just does primary beneficiary Hillary, and Hillary rolls it over into her IRA, that $100 million is not going to Georgetown, it's going to Wellesley. So Bill wants to be sure he provides for Hillary, but he locks it in for Georgetown. That accomplishes that. But even better, if you go to the next slide, Marty, and this is the one that I think is the unbelievable opportunity. Let that IRA beneficiary be a standby unitrust for the spouse and children. Stretch that sucker out over the spouse's lifetime and over the children's lifetime. Reverse the Secure Act. Go back to where it provides to the spouse for her life, the children for their lifetime. And by doing that and putting that 100 million or whatever it is in that standby CRUT and having the benefit of tax-free compound growth over the entire spouse's lifetime, the entire children's lifetime, including Muffy, that tax-free compound growth is going to end up making two gifts. It's going to give the spouse and children the same money that it would have given them by any other option. And then at the end of all that, it's going to give that money again to Cooper Union, the Council on Foreign Relations, whatever charitable organization the person wants to give to. They get to give that money twice, Marty, and I've run these numbers. And because I don't trust myself, because I know I'm biased. I love to see people give if it's what they want to do. And, all these years people have said to me, oh, you can make money doing charitable giving. And I've always said that's not true. And I still don't think it's true in most cases. But if you run the numbers here, it gets about as close to a zero cost gift as anything I've ever seen. And you get to give the money twice. So, maybe what they want to do is a standby CRUT for spouse and children, and then let it go to their private foundation. Let the children be the trustees of the private foundation. Teach them how to give. Let's go to one more slide, Marty, and we'll close if you'd like. Here's the same deal. I like a standby unitrust. A lot of people put this in a testamentary unitrust in the document. I like to create a standby unitrust, get the thing signed, put it on the shelf. You don't have to file any tax returns or anything, but you got it done. And then just make that standby CRUT the primary beneficiary. Let that standby CRUT pay income to spouse and children, plus a term of 20 years if we can make it work. The only restriction is we've got to have a 10% charitable remainder. That you've got for a CRUT to be legal and get all these tax savings, you've got to have some charitable gift. And the minimum you can have is a 10% charitable remainder. The present value has got to be 10%. So sometimes I've thought about it. Do you want to put $1 million, 10 million, 100 million in and avoid paying a 23.8% capital gains tax, where all you've got to do is have a 10% charitable remainder? And I know, Marty, I'm trying to make the argument for this, but I've talked to, there's a really wonderful lawyer in this area, Chris Hoyt. Some of you may know Chris. Smarter than I am, better at this than I am, certainly in this area, much better. So I called Chris. He had spoken down at Heckerling. And I said, Chris, does this work? And he says, Winton, it works. The numbers work. Now, Chris would not misrepresent this. And what I like about it is, I have 4 children. I love them more than life itself. But if I have a chance to leave them, a whole bunch of money over 10 years or provided for it over their lifetimes, the latter to me is a better plan. So I like that about the plan. And the fact that we now, Marty, have such a big gift tax, estate tax exemption, by
For
putting
now.
it by putting it in a for now, by putting it in a standby CRUT for spouse and children, you lose the marital deduction. That's not good. So you're going to have to use some of that exemption to shelter this from any type of gift or estate tax if you do it during their lifetime or if you do it at their death. But that's one of the most attractive plans I've seen in about 40 years doing this. And quite frankly, I'm having clients do this. They don't want the government telling them they got to pay it out over their spouse's lifetime plus 10 years and pay a ton of income tax. And so, provided they have charitable intent, I really hope the people on the webinar will at least show their clients this option. And, I think hopefully they'll have some very happy clients, and they will have a lot of satisfaction and eventually helping make this a better world.
That would be a wonderful thing. And I encourage people to have these conversations, whatever discipline you're in, with clients. Don't assume the other advisors have done it. Often they don't. And a lot of people I've talked to feel, well, if the client asks about charity, I'll show them these things. I think one of the important messages, it's not technical or complicated, that Winton has gotten across, is you got to show clients these options, because even if they come to you not thinking about charitable giving, the benefits may encourage them to rethink it. and
Marty, can we
it's a
do
good
one
thing.
more idea or are we at the
Sure,
end?
go for it. Go for it.
Okay, Marty, if you would turn to slide 81. Whoop, I'm sorry. Keep going. Okay, right here, right here. Now, when it comes to current giving, and I'm sure many people on the webinar have heard this, we've now got this charitable IRA where
Winton,
older.
repeat what you just said. I don't know if it came through, Winton.
Okay, we've now got this wonderful current charitable giving idea where if a donor is age 70 and a half or older, am I coming through now, Marty?
Yeah, yeah, you're fine.
Yeah. They can use the idea of a charitable IRA rollover. In other words, if they have an IRA, and particularly one that's requiring minimum distributions, they can take those minimum distributions at least up to the amount of $111,000 and direct those minimum distributions directly to a public charity. Many people we've all worked with who have IRAs, they've made those deductible contributions over their lifetime. They've watched them grow tax free over their lifetime. And then their accountant says you've got to take a minimum distribution. And Marty, they say, what? No, I don't. And the CPA says, yes, you do. Well, now, no, they don't. If they're 70 and a half, at least 111,000 of that minimum distribution can be rolled over directly to a public charity. It never comes into their taxable income. It never has an adverse effect on other tax ideas or considerations. It just goes directly from that IRA distribution to that public charity. If it's a married couple, as you see, they can double the amount. They can give 222,000 to their charitable interest, roll it over directly to that public charity, never comes into their income tax. It's the equivalent of 100% deduction because it never comes into their income. It's not subject to any giving limits. They do have to be 70 and a half, and it does have to be those amounts. Now, those amounts are adjusted for inflation. So you see the amounts in 2026, there'll be more next year. If you have a client who has an IRA and is required to take minimum distributions, or maybe even if they're not, that's probably the most tax smart way for them to make a current gift. You'd probably want to compare it with a gift of highly appreciated stock and run the numbers, depending on their situation. But boy, you talk about a dog that'll hunt, Marty. This one has really opened the door for charitable contributions. And, I don't think I've ever talked to a client that didn't like it
Yeah,
because they don't want
QCDs
to
are
take.
very powerful.
Yeah, they're very powerful. This has been such a joy, Marty. Such a joy.
I want to thank you, Winton. It was interesting. I hope everyone got something out of it. And when I come back to Memphis, you're going to show me that dog that can hunt all day. I want to meet that dog.
All right, we'll do
All
it.
right.
We'll do
Take
it.
care, everybody.
I'll take you to Graceland. We'll have to
There
go to
you
Graceland.
been there, but we'll go again.
Okay. All
Take
right.
care, everybody.
Take
Thank
care.
you for joining.